Hey everyone, Graham Stephan here, and today we're going to break down the world of stocks in a way that's simple, fun, and easy to understand. Whether you're a total beginner or just looking to brush up on the basics, you're in the right place. Have you ever dreamed of owning a piece of your favorite company, maybe Apple, Disney, or Tesla? Well, that's exactly what the stock market allows you to do. It's a place where everyday people, just like you and me, can become part owners of some of the biggest and most successful companies in the world. When you buy a stock, you're not just making a bet or playing a game. You're actually purchasing a tiny slice of ownership in that company. Each slice is called a share, and the more shares you own, the bigger your piece of the company. Companies sell stock to raise money for all sorts of reasons. Maybe they want to launch a new product, expand into new markets, or simply grow their business faster than they could on their own. By selling shares to the public, companies can get the cash they need to hire more employees, build new stores, invest in research, or even acquire other businesses. It's a win-win. Companies get the funds they need, and investors get a chance to share in the company's future success. As an investor, you buy these shares hoping that the company will do well and that your shares will become more valuable over time. If the company grows and makes more money, the value of your investment can grow too. Sometimes companies even pay you a portion of their profits, called dividends. All of this buying and selling of shares happens in a place called the stock market. It's a huge network where millions of investors and traders connect to exchange shares every single day. Think of the stock market like a giant online marketplace, but instead of shopping for shoes or gadgets, you're trading pieces of real companies. You can buy and sell shares with just a few clicks right from your phone or computer, and just like any marketplace, prices are always changing. The price of a stock goes up and down based on how many people want to buy or sell it. This is called supply and demand. News, company performance, and even world events can all affect stock prices. If this all sounds a bit overwhelming, don't worry. We're going to break everything down step by step, so you'll know exactly how it all works and what to watch out for as you start your investing journey. By the end of this video, you'll have a solid understanding of how the stock market operates, why it matters, and how you can get started investing with confidence, even if you have just a few dollars to spare. So, are you ready to dive in and start your journey to becoming a stock market pro? Let's get started. Alright, let's talk about where the magic happens. Stock exchanges. These are the beating hearts of the financial world, where fortunes are made, lost, and made again every single day. Stock exchanges are the official marketplaces where buyers and sellers come together to trade shares of companies, and they've been around for centuries, evolving with technology and the needs of investors. These platforms are where stocks are bought and sold, and they operate almost like giant, high-tech auctions. Every second, thousands of trades are happening, with prices constantly changing based on supply and demand. Think of famous exchanges like the New York Stock Exchange, the NASDAQ, or the London Stock Exchange. These are some of the most well-known, but there are many others around the world, each playing a crucial role in their local economies. They're the bustling marketplaces of the financial world, filled with energy, excitement, and sometimes a bit of chaos. In the past, traders would shout and wave papers, but things have changed a lot. But here's the cool part. It's all digital now. Most trades happen electronically, with computers matching buyers and sellers in milliseconds. This makes trading faster, more efficient, and accessible to almost anyone. You don't need to be on a loud trading floor to participate. In fact, you can trade from the comfort of your own home, or even while you're on the go. All you need is a brokerage account and an internet connection. With just a few taps on your phone or clicks on your computer, you can buy and sell stocks in real time, just like the pros. Speaking of brokers, they're your gateway to the stock market. Brokers are licensed professionals or companies that help you access the exchanges and execute your trades. They act as the middlemen, making sure your buy and sell orders are carried out quickly and accurately. Whether you're a beginner or a seasoned investor, brokers make the process smooth and secure. You simply tell them what you want to trade, and they make it happen for a small fee, known as a commission. Some brokers even offer commission-free trades these days. Now let's talk about the key players in this ecosystem. The stock market isn't just about numbers, it's about people and organizations working together. You've got companies issuing stocks to raise money for growth, innovation, and new projects. When a company goes public, it's inviting investors to own a piece of its future. Then there are investors like you and me buying and selling those stocks, hoping to grow our wealth or support companies we believe in. And of course, brokers are there to facilitate every trade, connecting buyers and sellers and keeping the market running smoothly. It's a dynamic, interconnected ecosystem where everyone has a role to play, and together, they keep the world of finance moving forward. Ever heard the terms bull market and bear market? These phrases get tossed around a lot in financial news, but what do they really mean? Understanding these terms is key to making sense of the stock market's ups and downs, and can help you feel more confident as an investor. They might sound intimidating or even a bit mysterious, but in reality, they're just colorful ways to describe the overall mood or sentiment of the market at any given time. Think of them as nicknames for how investors are feeling and behaving. A bull market is like a celebration that seems to have no end in sight. During these periods, stock prices are rising steadily, optimism is high, and there's a general sense of excitement in the air. Investors are eager to buy, hoping to ride the wave of growth and profit from the upward momentum. It's a time when good news seems to dominate the headlines, and people feel confident about the future. The term bull comes from the way a bull attacks, thrusting its horns upward. That's why a bull market represents prices charging higher and higher, just like a bull lifting things up with its horns. It's all about forward movement and growth. On the flip side, a bear market is the opposite experience. Here, prices are falling, sometimes sharply, and investors start to feel anxious or even fearful. The mood shifts from excitement to caution, and people may start selling their investments to avoid further losses. It can feel like the party's over and everyone's heading for the exits. The bear, in contrast to the bull, swipes its paw downward when it attacks. That's why a bear market is associated with prices dropping, as if the market is being pushed down by the bear's powerful swipe. It's a time when caution and pessimism take center stage. But here's the important thing to remember. Don't panic if you hear these terms thrown around. Markets naturally go through cycles of ups and downs, and both bull and bear markets are a normal part of investing. No market goes up forever, and downturns are often followed by recoveries. The key to navigating these market moods is to stay informed, keep your emotions in check, and focus on your long-term goals. Avoid making rash decisions based on short-term swings, and remember that patience and discipline are your best allies. Remember, time in the market is more important than timing the market. By staying invested and riding out the inevitable waves, you give yourself the best chance to benefit from the market's long-term growth. So, stay patient, trust your plan, and let the power of compounding work for you over time. Let's talk about the new kid on the block, cryptocurrency. You've probably heard of Bitcoin, Ethereum, and all the buzz around them. But how are they different from traditional stocks? Think of stocks like owning a piece of a company like Apple or Tesla. You're betting on their future success. Crypto, on the other hand, is like digital gold. It's decentralized, meaning it's not controlled by any government or institution. Cryptocurrencies use blockchain technology, which is like a secure, transparent digital ledger. This makes them very secure and difficult to counterfeit. But here's the catch: crypto is much more volatile than stocks. Prices can swing wildly up and down in a matter of hours. So which one is right for you? It depends on your risk tolerance and investment goals. Stocks are generally considered less risky and more established, while crypto is higher risk, but potentially higher reward. Here's something interesting. Sometimes the stock market and the crypto market move together like they're dancing partners. Other times, they go their separate ways. Why is that? Well, sometimes global events like economic news or political instability can impact both markets in similar ways. For example, if there's a recession, both stocks and crypto might go down as investors get scared. But here's the thing. Crypto is still a relatively new asset class. It's finding its footing and figuring out its own rhythm, so sometimes it might zig when the stock market zags. For example, if there's a lot of hype and excitement around a new crypto project, its price might surge even if the stock market is having a bad day. The takeaway? Don't assume that stocks and crypto will always move in sync. They're different beasts with different factors influencing their prices. Let's talk about the most important part of investing: your mindset. You see, investing isn't just about numbers and charts, it's about mastering your emotions. One of the biggest mistakes new investors make is letting their emotions call the shots. They get caught up in the hype, see their stock going up and think, "I'm a genius, I'm gonna be rich." Then, bam, The market takes a dip, and they panic sell, locking in their losses. This is called emotional trading, and trust me, it's a recipe for disaster. Another common trap is FOMO, or the fear of missing out. You see everyone talking about a hot new stock, and you feel like you need to get in on the action, even if you don't fully understand it. So, how do you avoid these emotional pitfalls and become a successful investor? 2 words: patience and planning. First, let's talk about patience. Investing is a marathon, not a sprint. It's about slow and steady growth over time, not trying to get rich quick. Remember, even the most successful investors have experienced losses along the way. The key is to stay calm, stick to your plan, and not make rash decisions based on short-term market movements. Now, let's talk about planning. Before you even think about buying a single stock or crypto, you need to have a plan. This means setting clear financial goals, determining your risk tolerance, and deciding how much you can afford to invest. It's also crucial to diversify your portfolio, which means not putting all your eggs in one basket. Risk. It's a word that can make even the most seasoned investor a little uneasy. But here's the thing, risk is an inherent part of investing. You can't avoid it, but you can manage it. The key is to understand that different investments come with different levels of risk. For example, stocks are generally considered less risky than cryptocurrencies, but even within those categories there are variations. A large, well-established company like Apple is probably going to be less risky than a small startup that's still in its early stages. That's why it's so important to do your research, understand what you're investing in, and diversify your portfolio. Remember, there's no such thing as a guaranteed return in investing. But by understanding and managing risk, you can increase your chances of success over the long term. Congratulations! You've made it to the end of this crash course on stock market basics. You've learned about exchanges, bull and bear markets, the difference between stocks and crypto, and most importantly, the power of emotional discipline and long-term thinking. But this is just the beginning of your investing journey. The world of finance is constantly evolving, so it's crucial to stay curious and never stop learning. Read books, listen to podcasts, follow financial news, and don't be afraid to ask questions. The more you learn, the more confident you'll become as an investor. Remember, investing is a lifelong journey. There will be ups and downs along the way, but by staying informed, staying disciplined, and staying patient, you can achieve your financial goals and build a brighter future for yourself. Now go out there and make those smart money moves.